one odd time when we have to get some speakers who are more from outstation. We do this online because this is a complex subject. So this subject to get a speaker, so we have to go any part of the world. So we have got quite a number of them from out to the world. Before I move on to the program, let me quickly tell you what's happening in MMA. Third thing, and tomorrow, I mean, MMA is blessed. For the next few days, we are getting some outstanding speakers. Tomorrow, we have a talk on discussion on changing fast and slow, how to find organization best pathway. The founder of Emphasis is coming, Jerome Tas, along with them, Renuka Ramnath. Renuka Ramnath, you all know she's the founder, MD of CEO of multiple alternative asset management company, one of the finest asset management company in country, Gopi Kodishwaran and thing. So this is happening tomorrow evening, live, present, this is not the thing, it's happening in person at MMA Management Center. Then on 17th, we have very, very interesting event. I really urge upon all the MSMEs, SMEs, manufacturing to come and see. Three outstanding thought leaders are going to come and speak. China plus one strategy. And we have got a speaker, Mr. Srinivas, is a visiting research professor from University of Singapore, National University of Singapore. Then we also have Frank N. Filke is a Dutch cultural anthropologist and also visiting research professor on China. Very, very well known and from Singapore. He is coming, and so we will have a very piece of a time on China plus one. We talk so much about China plus one. How is it happening? Where is it happening? How is it going to impact Indian businesses? All will be very nice. See, it's happening again in person on 17th of November, Monday at MIM. Then we also have
Hello.
an event on Read and Grow with Sangeeta leading the thing. How successful people lead, taking your influence to the next level. This is my more we do it for the management students. It's happening on 17th. Then on 3rd of December, again we have a nice talk by Dr. Arvind Subramaniam. He's a former chief economic advisor. Along with him, we're also getting Subarao, RBI governor. We got an outstanding panel. It's happening again live in person at MM Center. Then on 12th of December, we have got Mr. Amitabh Khan, former chief Niti Aayog chairman and Sherpa. He is coming at MMA and he is delivering 7th R.K. Swamy Memorial Lecture. It's happening at MMA. We also in December a talk by Professor Dolakia, director of RBI board. We will lined up some very good speeches. Now I'll talk only with what is very, very important. And if you see, I don't know, it's happened by design or by force. The today's topic, where is the money coming from? All the speakers who are going to speaking next few days will be able to tell us where the money is coming from. The former chief economic advisor, RBI governor. I think it's happened by not by design. It's happened accidentally. So what I would urge upon you, you attend this program, you will find more solutions when you come and attend that other programs. What is happening in MMA, and when Mr. Satyamurthy suggested to have this program, where is the money coming from? And I read the synopsis. I really got lost. I didn't understand anything. I said it's a very complex subject. Then he said that is what we should discuss. This is what is happening today in the environment. This is what is happening because of geopolitical issues. And then we need the speaker who are of top-notch leaders who can speak on this, bisect and dissect. That's why we got some outstanding panel here. The format of the program today is I'm going to request Ms. Lakshmi Narayan to formally deliver the welcome. Thereafter, Satyamurthy will set the contract. Then thereafter, I'll formally introduce all the three distinguished speakers, outstanding speakers we have today. Then, if you have any question, as usual, you can scan the QR code, send it to me, the number which is flashed. We'll collate all the questions and place it before distinguished speakers. Now, to move forward, Ms. Lakshmi Narayan Duraswamy is President of Madras Management Association. He is also Managing Director of Sundaram Home Finance. He's been a great supporter and he's also cost accountant by profession and he's done his MBA. And great support under him. MMA is growing leaps and bounds to reach out to all level. Multiple new initiatives may now request Lax to deliver the formal welcome address. Over to you, Lax.
Thank you. Thank you, Group Captain. Good evening, everyone. It's indeed an honor and a privilege to formally welcome you to this unique online session exploring the theme, Where is the Money Coming From? This important dialogue has been made possible through the collaborative efforts of Policy Matters and MMA with vital support from CAS. This evening, we are joined by an outstanding panel of experts, Dr. S. Narayan, IAS, retired, former economic advisor to the Prime Minister and Finance Secretary, Government of India. Mr. Shyam Sekhar, founder and CEO, iThought Financial Consulting LLP. Dr. Arun Kumar, retired professor of economics, JNU, New Delhi. Mr. N. Satyamurthy, convener, Policy Matters, Chennai. I also take this opportunity to warmly welcome all the participants from MMA, Policy Matters, and our partner organizations, and viewers from across the globe who've joined us online for this program. The Indian economy is currently witnessing a surge in growth indicators with unprecedented highs in bullion prices, land values, and stock market, all at the same time. This remarkable trend suggests that liquidity is abundant, reflecting optimistic revisions of India's GDP by international financial institutions and credit rating agencies. Many of the experts now anticipate India securing its place amongst the world's top three economies alongside US and China in the near future. Yet these achievements are accompanied by persistent concerns. The rising cost of commodities and consumer goods, widening gap between the rich and the poor, the ongoing socio-political implications also must be acknowledged. Additionally, the global headwinds such as the higher US tariffs on Indian exports, geopolitical instability, and the risk of recession in advanced economies threaten to dampen the external demand and create challenging business conditions in India. Imported inflation resulting from escalating prices of crude oil, food, and precious metals further adds pressures to both households and businesses. So, amidst all of these things, the central question before us is where is the money actually coming in from? What trajectories can we expect for key economic indicators in the coming months? Our distinguished speakers from the fields of government, academia, and financial investments are here to help us navigate through these complex issues, providing much needed insight into some of these challenges and opportunities ahead of us. I wish to extend my sincere gratitude to my colleagues on the management committee, all members of MMA, and our esteemed invitees, and our partner organizations for joining us today. Your participation enriches this discussion, and I look forward to an enlightening and engaging evening. Wishing everyone a productive and a thought-provoking session. Thank you and good evening, and over to the panel.
Thank you, Mr. Narayan, for sitting and welcoming the people. Now, I'll have the privilege of requesting Mr. Satyamurthy, is the convener, Policy Matters, Chennai. We have been having collaborating with Satyamurthy, one of the thought leader, and he also writes in leading newspapers. He is a specialist on neighbors, Maldives, Sri Lanka. I know Sri Lanka. Sometime highest level of Sri Lanka ring up and ask him for consultations, and he's also convener of Policy Matters, Chennai. Formerly, he headed the Chennai Institute of Initiative of Observation (ORF). Actually, now I request Satyamurthy to give his opening remarks, set the context. Over to you, Mr. Satyamurthy.
Good evening, everybody. And I should thank Dr. S. Narayan for the topic of the day. Not long ago, we were discussing the same issue, and this topic and even the title suggested itself out of it. I was looking at, I'm reminded of a situation in the mid-90s when a senior executive in an international bank, a cousin of mine, who should have known, asked me, where is the money coming from? Because for the Harshad Mehta scam, the stock prices are booming, etc. By then, I had done some footwork, literally. The gold prices have not come down. Land prices have not come down, which means the money has to come only from inside the system. I said somewhere it is going out of your banking system. It may be a bigger Nagarwala than Nagarwala. That is what I told him. Ultimately, that is what happened. Now, the question is, where is the money coming from? No, I am not suggesting or drawing a parallel between Harshad Mehta scam and now. Their money is actually coming. And as Mr. Doraiswamy pointed out, every sector is getting money. That is also what our synopsis says. And where is the money coming from? Of course, it is for the experts on the panel to talk, to tell us what it is all about. In between, I should part with an observation made by Mr. M.R. Sivaraman, former Revenue Secretary and former Executive Director of IMF, who are talking to me on this subject after receiving the invite. According to him, this is a thought for the panel. It comes out, mainly the money is coming out of the public debt. That is some, and nearly 12 lakh capex investment promised by the government, and it is which is all
It's
in the pipeline. And he said nearly 50 lakhs of savings by the domestic savings and corporate profits are also in the banking system, which the government is using to pay for the debt. So it is a complex thing. I leave it at that. And I think the experts should enlighten us about where is the money coming from. Thank you.
Thank you, Satyamurthy. And I know we are all eagerly looking forward to the thing. Before I request our distinguished speakers, the format of the thing, really, I'll request Mr. Narayan will go first and share his insights. Thereafter, Professor Arun Kumar will talk. The last, but not the least, Shyam will share his insights on the financial thing, on the thing. Thereafter, as usual, we'll take all the questions. Please send your questions online. We'll be collating all of them and place it before the distinguished speaker. Before I request the speaker and Mr. Narayanan, can I let me have the privilege of introducing the distinguished speakers? Can I have the AV, please? Shankar, can I put the AV, please?
Dr. S. Narayan, IAS, retired, is former economic advisor to the Prime Minister and Finance Secretary, Government of India, with nearly 4 decades in public service. Dr. Narayan played a key role in shaping India's economic and fiscal policies between 2000 and 2004. A visiting faculty at NUS and LSE, Dr. Narayan writes and lectures widely on economic reforms, governance, and public policy, and serves on several corporate boards. Mr. Shyam Sekhar is the founder and CEO of iThought Financial Consulting LLP and founder and CIO of iThought, managing 6 SEBI-registered PMS schemes with an AUM of 3,400 crores rupees. With over 15 years of experience in investment management, Mr. Shyam is known for innovative, research-driven strategies. Mr. Shyam's mission is to foster financial wellness through education and investment excellence. Dr. Arun Kumar is a retired professor of economics from Jawaharlal Nehru University, where he held the Sukhmoy Chakravarti Chair and is currently the Malcolm Adisesha Chair Professor at the Institute of Social Sciences. A PhD in economics from JNU and a Princeton-trained physicist, Dr. Arun specializes in development economics, public finance, and macroeconomics. Dr. Arun is widely known for his work on India's black economy, public policy, and alternative economic frameworks.
Ladies and gentlemen, that's a profile of our very distinguished speakers this evening. Now each speaker will speak for about 15 minutes. Thereafter, we'll go to the Q&A. I will now request Dr. Narayan to please share your insight. Dr. Narayan.
Thank you very much, Group Captain, Mr. Satyamurthy, Mr. Lakshminarayan, and thank you for inviting me to be part of this discussion. And what you have chosen is a fairly complex subject and very much looking at the Hindu elephant from different points of view. I'm sure that there are different views on what exactly is happening in the economy. Firstly, let us look at the question: where is the money coming from? In the sense that obviously everybody agrees that there is a boom in expenditure, in spending, in growth. Something is happening, which was not happening 5 or 10 years ago. So if you just look at the numbers, consumption spending in 2023 was 2.15 trillion US dollars as compared to 2019, which was only 1.7 trillion US dollars, which means there's an increase, huge increase of nearly 25-30% in consumption spending, which has happened just over these 4 years. We don't have 2025 figures, but even if you look at 2023, this is the kind of increase that is happening. Further, if you look at household debt, household debt has gone up from 26% of the GDP to 48.6% of GDP, of which 55% is non-housing retail loan, which means people are borrowing. People are borrowing retail. People are borrowing non-housing, which means they are borrowing for their credit cards, they are borrowing for consumption expenditure, for travel, etc. So there is a boom in spending that is happening, and the spending at the first level is happening through debt, through consumer debt. Now the consumer debt, how it will play out in the hands of the lender and how the lender will secure, because a lot of it, credit card debt and all, is mostly unsecured debt. So how it will play out in the hands of the lender is something we'll have to see. But the hope of the people who are borrowing is that they would be able to meet their debt obligations arising out of their future earnings and their growth in earnings and their growth in wealth. But I'm setting this context to say, yes, people are spending more, people are having more, therefore people are having more money to spend. Three other sources which were briefly mentioned for in the introduction is also very, very obvious to all of us. One, of course, is that land prices. Land prices are going up all over urban cities and over tier 1, tier 2, tier 3. And anybody having a land is able to monetize it much faster now, and therefore a lot of liquidity is coming into the hands of people who are holding even small parcels of land, whether they are holding it for 5 years or 10 years. A doubling of land prices in 5 years is quite common in urban cities. And this immediately gives rise, land monetization immediately gets rise to a substantial increase in the cash economy, because as all of us are aware, land transactions substantially involve a lot of cash. And this cash economy, once it is converted into cash, the cash naturally goes into, I would say, non-identifiable investments, mostly into gold and jewelry and silver and maybe further real estate, additional real estate. So this multiplication is happening, and is happening significantly in the last 5 years. If you look at central areas, Chennai, where I live, and I live in partly in Coimbatore, I have seen doubling of land prices happening over the last 5 or 6 years. A doubling of land prices and conversion and more urbanization is pushing agriculture land into urban construction hands, because it is much more economical for the seller to convert his land into cash at the higher rate rather than to continue to grow crops. So therefore, there is a huge real estate money which is also coming into the system here. And that is also coming partly into the banks and substantially into cash as well. But at the back of all this, why is it happening? Why are people buying? How is it people are able to buy in central Chennai properties worth 6 crores, 7 crores for an apartment? In cities like Coimbatore, 2 crores, 3 crores for apartment. I mean, how is it happening? So one, I said, it is also consumer spending is happening through household debt. That is one part of it. But substantially, there is some kind of a saving or some kind of a stock of money which is available, which is now freely available to be spent. So a person who sells a property, a land, usually goes in for an apartment. So that money is reused in that apartment, and definitely at the apartment prices keep going up because he has secured something like an unexpected gain out of the property that he is having. All this is happening primarily because of, I would say, 2 or 3 factors. One is, overall the economy is growing substantially. If I look at the overall size of the national budget, The revenue, the revenue budget or the total revenue receipts, which were about 19.62 lakh crores in 2019-20, are 34 lakh crores now. And if you look at the total revenue expenditure, of the national budget, it used to be 27.86 lakhs crores in 2019-20. It's 50 lakh crores now. And that is an increase of close to 60 to 70%. Remember, this is all in nominal terms because we are spending today's cash. The real term number comes only for economists and only for calculations, but everybody is spending today's cash. Today you go and buy rice, you are paying 70 rupees. 5 years back, maybe you are paying 40 rupees. But okay, look at today's cash. Today's cash, you have 70 rupees to buy that same quantity of rice. And if you look at GDP, the other way is that if you look at GDP per capita, again we have very, very interesting numbers that in 1990, just about 30 years ago, our GDP per capita was $371 at those dollar conversion prices. Today, at much higher dollar conversion prices, our GDP per capita in 2024 was 2,700. Now, 2,700 is not joke. And if we are staying and we are getting pulled down by some of the states like Bihar and West Bengal. But if you look at Tamil Nadu, it's substantially higher, 1.4 times, 1.5 times higher than 2,700. We are close to $3,000 to $4,000 per capita income. The other development which has happened, which again is very, very visible, and this development that has happened is that we have had very, very good agriculture crops in the last 2 or 3 years. The 3 years have been very good for agriculture. So there are huge agriculture surpluses. Actually, the problems of the agriculture agitation in Punjab and currently the problems being faced in Tamil Nadu by farmers growing much more than what the government can buy is because the agriculture surplus have been substantial. And there is also, in addition, there is also huge diversification in agriculture into cash crops, into vegetables, into fruits, into flowers. Therefore, much more money is coming into the agriculture hand. And the most interesting thing is, this is all cash. This is all untaxed cash. We have a wonderful system which is built into the constitution that agriculture income cannot be taxed unless it is done by the states. So which means that if you are growing 340 million tons of food grains every year, that is equal to that much of, if you even take 1,000 rupees or 2,000 rupees per kilogram, that much of cash is being generated out of the ground, out of the bhumi, every 4 or 5 months. And this cash has to have expenditure. And because the living expenditure, the actual cost of living has not gone up to that particular extent, therefore the surplus is available for distribution. And particularly when many states are giving a lot of freebies, free food, free rations, free school textbooks, free school meals, free bus rides, etc. That means the cash available even in the tier 2, tier 3 cities, as my friend Mr. Lakshmanan will bear out, the cash available is quite substantial. And this is easily visible in a city like Chennai, where if you start visiting, even whether it's a small restaurant or a big 5-star hotel, you see full. If you go to a temple, temples are full. The donations which are pouring into temples are reaching record levels. So this is a multiplication factor happening out of liquidity coming out of land, liquidity coming out of increased per capita incomes, liquidity coming out of debt, and liquidity also coming out finally from the market. The stock market have also performed extremely well, and very ordinary people who had never think of venturing into the stock market are now ready. Youngsters, particularly the age of 25 to 35, 40, are willing to go invest into the stock market and to see returns. Unfortunately, they are not very wise. So there have been a lot of losses that people have suffered who have gone into crypto, etc. But the courage with which people are entering the stock market is quite amazing. And if you look at if you look at the more cautious people who are going into mutual funds and systematic investments, I mean, it's close to 1.5 lakh crores of rupees are being connected every year. That means whenever the foreign investors are pulling out, the Indian investors are stepping in, which are keeping the markets high. So where is it going forward? I think where is it going? It's going forward because somebody did mention the inflation. Going forward is that if this rapidity, and let's not forget that in real terms we are growing at something like 6.5–7%. In nominal terms we are growing at 12 to 13%, and that is the amount of goods that are going to be consumed every year in addition. So what is happening is that our manufacturing market, and manufacturing, I don't mean engines and steel and alone. I mean even the consumption manufacturing market. People who are doing FMCGs, people who are doing even two-wheelers, I'll call that a consumption good now, are not increasing as rapidly as the demand is increasing. And their reason is that a lot of, you see, in India is very peculiar that the family held firms constitute something like 50–52% of the stock exchange, of the stock market. And for a family held concern, it is the target is to maximize wealth for the family rather than to produce so much more goods to internationalize, because he is much more family oriented. You can see a lot of companies in India, a truly I would say shareholder head conglomerate in India on a large scale, in Tamil Nadu particularly on a large scale, does not exist. Therefore, the conservative investment patterns that the conglomerates are following is contributing to some stresses in the economy in terms of goods available to be purchased, and which is why you are also seeing a pressure on inflation and pressure on prices. If only we were a truly market-oriented economy, we would have much more competition coming into these areas, and we would have much more alternative goods available for purchase. My final thought here, I'm a little running out of time here. My final thought here is the benign oil prices that we are seeing, particularly since January, when oil prices have been fairly steady, which means our expenditure on oil as a percentage of the total GDP remains steady, even though the GDP is growing very fast. Not steady, it's actually dropping. So the current accounts deficit is actually not the oil price is no longer a big concern for the current account deficit. Then this is very interesting, because that means that money is available. Let us say if there are 2 lakh students going abroad, each costing half a crore to send out a child overseas to study, that money is coming out of private individual savings, not out of government expenditure. So the government money which is being spent for oil is actually quite steady over the last few years, and now the current prices are benign and likely to be benign for quite some time. So I will end. It's a bit, what I have said is a bit fragmented, but in a way these are the thoughts which are uppermost in my mind, and I'll be happy to take any further questions. Thank you.
Thank you, Dr. Narayan. Great insights. Now we'll move on to Professor Dr. Arun Kumar. Can I have his PPT loaded so that he can start? Dr. Arun Kumar. Professor Arun Kumar, you're there. You're able to hear me? Professor Arun Kumar, can I load your PPT. Able to hear me, sir? One more minute, sir. I'll try. You'll join us. Otherwise, we'll move to Shyam.
His name is on the screen.
Yes.
He has appeared.
Yeah. Good evening, sir. Good evening. I think you're coming a different name, actually. I was looking at Arun Kumar, the another name which has come. Professor, can I share the screen? You have to unmute yourself, Professor. Shankar, can I share Professor's PPT, please, onto the screen? I would like to share it yourself, so we can give screen share. Fine.
Yeah, okay.
Yes, sir. Clear.
Okay.
Fine, sir. Fine.
So, can you move the PPT?
You say next, then he'll move us. Yes.
Okay. So, as a preliminary, we should be talking about incomes and not money, because money is a small part of the wealth. Okay. All assets are a portfolio of assets with money as only one component of it. Okay. So, what I think somehow it's disappearing. Okay. Now, in a feudal society, growth is not that important, but in a gapless society, it is all about growth. So inequality is less important in the feudal society than in a capitalist society. Capitalist society is driven by profits, and they are generated through more and more output. So higher growth leads to higher profits. Can I have the next slide, please? Yeah. So as an introduction, growing inequality checks growth by curtailing demand. And also, such a growth becomes unstable because there's a lack of coordination between investors. And that's why, a capitalist economy goes through cycles, and the average growth rate therefore declines. Next slide, please. Okay, so now we are talking about the middle class, which is supposed to be the consuming class. But the question is, how do we define this middle class? Indian middle class is not like a European or a US middle class. Those middle classes are able to spend very freely. They have a high income, they don't take their equipment for repairs. We take our equipment for repair, etc. But the point is that even if we define the Indian middle class in terms of those who are able to consume, it is very small. So even by Indian standards, our middle class is not very large. As we know, 94% of our workers are in the unorganized sector. And I'll come back to this question. They earn very little. So what is the middle class? Maybe only a few percentage of the population. Okay. And those who are substantial spenders, they may be around 3% of the population, and they have substantial black incomes to spend. So roughly about 3% are those who are spenders, who can spend quite freely. 5% may be middle class, who are not that free in terms of spending. And the remaining 93, 94% are basically those who don't spend that much, in the economy. So even this 3% is quite significant, but because of the 145 crore people, we have 4.5 crore people, which is like a good sized European economy. So in the midst of a lot of poverty, about 140 crore people who are, below the middle class, there are only 4.5 crore who are the spenders, but they are also quite significant. Next slide, please. So why is this happening? It is because India, by world standard, is a low per capita income. Our per capita income is around $2,800, whereas the US has $88,000, Germany has $55,000, and Japan has $33,000. And why I don't go for PPP terms? The PPP terms is actually a double whammy for the poor. Why is the rupee valued higher in PPP terms? Is because the poor people give cheap services, but they don't consume those goods. Like, for instance, a hamburger. a poor person will not consume a hamburger. Whereas hamburger is cheap in India because the poor people charge very low salaries. Similarly for other services that the middle class and the upper classes consume, they are cheap because of the cheap labor that is available here. But the cheap laborer doesn't have servants and so on, right? So in other words, I always compare in nominal dollars rather than PPP dollars. So therefore, this comparison above of India with $2,800, US with $88,000 is in nominal dollars. So India's market size becomes large because of the large population. It's not because the per capita income is very high or the purchasing power of the individual is very high. And that's why India is at the 140th position globally in per capita terms. So India comes quite low. So its market size is not very large because of the population. It is just not because of the per capita income, but because of the population. Next slide, please. Okay. So the key problem is that India has a huge divide between the unorganized sector and the organized sector. And unfortunately, the unorganized sector has been declining, especially after demonetization, because demonetization hit the unorganized sector. Then the GST, which is structurally faulty, hit the unorganized sector. Next year after that, in 2018, the NBFC crisis hit it. And then the pandemic hit it very hard. So the unorganized sector in India has been declining, whereas the organized sector is what is rising. But unfortunately, our GDP is calculated on the basis of the organized sector. So if you look at the 2017 method by which GDP is calculated, then you find that of the 39 subsectors of the unorganized sector, 29 are measured using the organized sector data. In other words, the unorganized sector proxies for the unorganized sector in a very large extent. So a declining sector is proxied by a rising sector. And that's why I've been arguing that the GDP is overestimated. So between 2016 and 2014, there were 4 big shocks, as I mentioned. And because they affected the unorganized sector more than the organized sector, therefore, and they haven't recovered. Therefore, our problem is that the Indian economy has been growing at an average of around 2% since 2016, not 7%. And one example of that is the demonetization year. The demonetization year officially grew at 8% and more. Whereas everybody knows that in the month of November, December, January, February, March 2016-17, the economy was down. Markets were shut. The fruits and vegetables could not come to the mandis and so on. So actually, the economy had declined rather than grow at 8%, but officially we said 8%. Also, in the measurement, we project from the previous year to the next year. But when we are projecting from the pre-shock year to the shock year, then we are overestimating the economy. So if the economy is growing at 2%, not 7%, that our GDP is overestimated by about 50%. But then the international agencies are also saying that the Indian economy is growing at 6.5%, 7%. But international agencies are not data collecting agencies. They take the government data and then they present that data with minor modifications. So the error in the official data is also the error in the international agencies' data. Next slide, please. So the point is that the stock markets are growing very rapidly, but only about 6,000 corporates are represented there. The 6 lakh small and medium units are not there. The 7 crore micro units are not there. 11 crore farmers are not there. So in other words, the stock market boom is only reflecting the organized sector boom, but doesn't mean that it's reflecting the small and medium units and the micro units growth or the farmers' growth. And where do we get the alternate data for the unorganized sector? The government was forced to set up the e-Shram portal. And on the e-Shram portal, what happened was that Prime Minister himself said a year back, the 300 million unorganized sector workers have registered. And now that number would be probably even higher. And initially, what was shown on the e-Shram portal was that 90% workers were saying they are earning less than 10,000 rupees per month. In effect, they were close to the poverty line and they hardly have any savings. The second evidence is that 2 years back in the August 15th speech of the Prime Minister from the ramparts of the Red Fort, he said that effective income taxpayers are only 15 million out of a population of 1.45 billion. That means effectively 1.1% have high incomes on which they are paying the tax. And now this number may be even less because our exemption limit has been raised to 12 lakhs of rupees. But even if it is roughly the same, it means only 1.1% Indians have high enough incomes to be effective income taxpayers. So even though the number of return filers and TDS payers has risen to 9.5 crores, but effectively because of the high exemption limit, roughly about 6 crore go out of the net. And remaining 3.5 crores also effectively only 1.5 crore are paying effective income tax. The remaining about 1.5 crore pay very little tax because they show a very small income. So in other words, the base on which savings are made is very small in the Indian economy. Next slide, please. So who are the savers? As I'm trying to show from this data on the income tax and on the unorganized sector, the number of savers is very small in India. These are those with high incomes, which is, I would say, roughly 3% of the population, and another 5% maybe from the middle classes and so on. These are the people who actually save and who have the money to invest in the economy. So as income inequality increases, savings will rise and tax collection will also grow, because it's when income inequality rises, it means that those who have higher incomes, their income is going up more. And if their income is going up more and they are saving, the savings will rise. And because their income is going up, so tax collection will also be rising. So the rise in the savings propensity in the economy and the tax collection is because of the rising income inequality, not because many more people are able to save. But then what happens? When this income inequality rises, then demand slackens, because those at the bottom are not able to demand, the basic goods of the economy. So when that demand slackens, capacity utilization goes down. And RBI's Obicus data shows that for the organized sector, capacity utilization has been hovering between 70 and 75%. Now, when capacity utilization is between 70 and 75%, you would not invest more. You would begin to invest more when the capacity utilization goes to 85%. And therefore, what has been happening is that the private investment in India has not been very buoyant. And when private investment is not buoyant, then the organized sector itself begins to slow down. The government is complaining that we are boosting the public investment. Last 3 years, the public investment has gone up very substantially. But the public investment is only 25% of the total investment. 75 share comes from the private investment. So unless the private investment begins to go up, the overall investment will not go up. And when the whole growth depends on the investment rate, and the investment rate begins to go down, then the growth becomes unstable. So it goes through ups and downs, and rather than a steady growth pattern. So in other words, we have to see how the private investment can rise. That is when we can say that the growth will be stabilized in the economy. Next slide, please. So in other words, we can say that India cannot become a rich country by 2047 at the present rate of growth. And the short term is damaging the long term. Because when the unorganized sector declines, and that has 94% of the employment, then the decline in the unorganized sector will lead to high unemployment. And India is characterized more by disguised unemployment, underemployment, and those who've given up looking for work. So our labor force participation rate, which is hovering between, if you look at the ILO data and CMI data, it's around 45, 48%. If you look at the government data, it's around 55, 58%, but much less than the labor force participation rate in other big economies like Brazil, China, and the US. So there's a large amount of unemployment of 3 or 4 different kinds, which is not measured in our unemployment data. So unemployment is much larger. And now what's happening is that with the coming in of the artificial intelligence, this might rise further. This rise in the use of artificial intelligence, while it's good for different sectors, it will also displace mental labor. Till now, whenever technical change used to take place, it was physical labor that was displaced. So on the farm, instead of using bullock, you use tractor, and it can do what work was being done earlier in 3 days, in 3 hours. If you cut the crop, you're using harvester combine as compared to cutting by hand. So that was physical labor being displaced. Or in the factories, robots have come and they're displacing physical labor. But now mental labor, so work of doctors, chartered accountant, lawyers, etc., is going to be displaced. Now, already coding work, quite a lot is being done, or even research like M-fold can, analyze the fold of proteins, of lakhs of proteins very quickly, whereas earlier for one protein, one PhD used to be done. So in other words, there's speeding up and displacement of scientists and others also happening. So what this is leading is to a new form of capitalism. This new form of capitalism is something that we'll have to grapple with, because it will keep on displacing more and more people from work. So how will savings get generated? And especially if the white collar workers start getting displaced, then these are the savers. And when their savings go down, then it'll have a lot of problem. So all this will lead to, in my judgment, political and social instability, and that will impact the investment climate of the economy. Next slide, please. Okay, I think that's it. Thank you very much.
Great insight with a lot of data. I know the chartered account hearing this thing must be really, really jittery. What is going to happen to that job? Now I request Shyam. Shyam is laughing, so he's also in the same thing. Over to you, Shyam. We would like to hear your insights on that.
Thank you, Professor. I think after listening to both our illustrious speakers, it's a little difficult to follow Professor Arun Kumar, because I think he has given a very dark picture of what lies ahead. But frankly, I think that going to your topic, where's the money coming from? The money is primarily coming from the structural changes which the government has done in taxation. We had corporate tax cuts first, then followed by personal income tax cuts, followed by GST reduction. So these three things are definitely helping the economy significantly. While we can debate as to how long this will sustain, and whether these measures are more like stopgap measures which will just prop up a slowing economy, or they can accelerate an economy from where it is today, that remains to be seen. But as things stand, I think that these three measures have worked on the ground to ensure that the economy continues to grow at a reasonable rate. And also, there is one point which is very, very important and not much noticed. In the last 1 year, while urban consumption has been under stress, rural consumption has definitely supported the economy. So if you see the kind of rural consumption in various products like tractors, like SUVs, like two-wheelers, and various consumer products, and then management commentary of so many companies, it's clear that money is coming from the rural economy. So it is not supporting the view that there is going to be some very dangerous thing that will happen in the rural economy in the near future. So I think that rural consumption is happening, and it is supporting the economy significantly. And after a long time, the rural economy has been the big support to various industries which have been dealing with consumption. And today, the hope is that with all these changes in personal income tax, in GST, and the upcoming pay commission, urban consumption will also, come back slowly. So broadly, money is coming from the government. Government is putting more money in the hands of the citizen, and citizens are consuming. It's very clear. The second thing is that while citizens are consuming, they also have had a tremendous wealth effect because of the boom in the other asset classes. Today, gold prices are at an all-time high, almost very close to it. You have real estate prices also, which are very close to an all-time high nationally in different parts of our country. And people are able to liquidate properties, as Professor Narayan very aptly pointed out. And all this is putting a lot of money in the hands of people, which they are spending, investing, and also, putting to better use. I think capital is being put to better use by those who are coming into money. And that money is what is, supporting the economy today. Normally, if you have a year like 2026, where the FIs have pounded the Indian market by selling incessantly, you would see the stock market at lows. Instead, you're seeing it within 300 points of its all-time high, which was made last in September of 2024. So 1 year later, despite nearly 14 months of non-stop incessant selling by the FIs, the market has sustained itself. The reason is that the domestic investor has enough liquidity to invest in the economy. And in fact, the domestic investor has invested with far more confidence than the corporate that's the very interesting aspect, which I think I will agree with both our speakers, that the corporate investment has not kept pace. But the domestic investor has certainly done very well. In fact, if you see the AUM of the Indian mutual fund industry, it has gone to nearly 80 lakh crores. It's the highest in history. Last month, it has grown from 75.61 lakh to 80 lakh crores. If you look at the SIP book, the money put by the middle class largely every month into the stock market, it is now at 29,529 crores in the month of October. And it has been steadily rising from the lows of COVID. So we've had nearly 5 years of SIP book building. If you see the number of accounts that have contributed this money to the SIP, it is 9.45 crore accounts. I mean, that's a very big number. And the total number of people who are, investing in India through the SIP route is 9.88 crores, which is nearly 10 crores. And it's a growing number. The number is continuously growing. So domestic flows into the capital market clearly show that the money put by government in various forms, I gave 3 or 4 ways in which the government has put more money in the hands of people. But there are other things like, doles, subsidies, state governments putting money in the hands, various welfare schemes, which have now made expenditures redundant. Like if somebody was, if a lady was going by a bus and was buying a bus pass, that money is free. Likewise, so many things are being given to people. And that money, again, is available for them. And that is all finding its way into the economy in the form of investments, in the form of consumption. And it's very visible, and you can see it. And these are things which, have definitely supported the economy and the stock market significantly in the recent years. I think Professor Arun Kumar spoke about, the shift from the unorganized to the organized, and how, it can affect the economy. I think this shift is only going to gain momentum. It's not going to slow down. Multiple industries are going to get organized. When these industries get organized, they are going to create scale in the activities that they perform. The activities are very much going to continue being performed. So it's not as if because there's a shift from unorganized to organized, a particular product or a service is not going to be rendered. It is going to be rendered by a much more efficient entity. I think all this is leading to scale. It's leading to other economic opportunities, including employment. So I would not worry about employment being lost because of a shift between unorganized to organized. I think this shift may actually do a lot of good to people, because this formalization is leading to financialization of the people who are being employed by the organized sector. And a lot of these jobs are actually in the form of gig jobs. Though the sector is organized, the jobs are not permanent, so they're in the nature of gig jobs. And despite being gig jobs, I think that people are developing financial history, which is again giving them access to credit. Yes, the credit in the economy, the amount of indebtedness is going up, but people seem to be comfortable with it. And as long as the stress doesn't, affect them, and they're able to manage, I think that people will continue to consume as much as their capacity permits. So overall, it looks like the consumption-led economic growth is broadly here to stay. We will see fluctuations here and there, but I think the growth is here to stay. And the government has proactively done quite a few things, starting from the corporate tax cut, which it did a few years ago, to the personal income tax cut, which it did in the last budget, to the GST cuts, which have happened in the month of September, October. I think the government has been very proactive in many areas, and it has put a lot of money in the hands of people. And that money, in turn, is being invested. It's being used for consumption. It's being used in different ways as people want to, utilize it. And this utilization is definitely leading to a lot of new trends in consumption, in lifestyle. And that, in turn, is leading to a lot of social change in how people want to see their future and see their present, and what they want to do with money, and how they want to go out and earn more money so that they can live a better life. So I think that there is an aspirational class which is now growing fastest than ever before. And it remains to be seen how this aspirational class is going to contribute further to the economic growth, and by virtue of contributing to the economic growth and productivity, how this aspirational class is going to consume more in the future or continue consuming as they do in the present long into the future. That is something that we'll have to see, but I personally am quite optimistic. I think with the level of financialization that has happened already and the rate of financialization that is going to happen in the future, I think that Indians are going to come into a lot more money in the future than we have in the recent past and than we do in the present. And this financialization in turn is going to make consumption sustainable for a very, very long time to come. And we are also going to see the government's finances improve, and they have been progressively improving from the bottoms of the COVID. And you're seeing a very, very stable, manageable current account deficit. The fiscal deficit has been almost to the trajectory which we wanted it to be. And the government has also invested and given a boost. Government has spent a lot of money in the last few years. Now it's the turn of the private sector to spend a lot of money, and people have to spend a lot of money. They continue to spend a lot of money. And lastly, there's one thing that has to happen for us, which is still open-ended. That is, exports should grow faster in the future than they have in the past. I know this is not the best time to, say that, because the environment still looks hazy until we make the tariff deal with the United States, I think, and the FTAs with several other countries which are in progress. I think that there'll be a lot of uncertainty, but I expect that the exports are going to also, take off, and we are going to see a different trajectory in the coming years than we have in the past. And if all this happens, I think the Indian economy will come into a lot more money in the future than we have in the past. The last 5 years have been quite adventurous if you look at it from the point of view of the stock market, where people have shown exuberance and unusual and irrational exuberance at times. If you look at all that, you may feel a little uncomfortable, but I believe that everything will normalize over a period of time, and I think that our economy will become more mature going forward, and the government has all the levers to address issues as and when they arise, and that's our recent experience. And there is no reason to believe that we would not be able to continue to do that. I think we will be able to manage that quite well. I think the money is there. It's quite evident that the money is there, because otherwise we would be in the place that we are in as an economy. And people have the confidence to borrow for the future and spend in the present, which means that they are committing to that productivity in the future. It's not just, it's not like America. Indian borrower has to, be far more responsible than America. It's not possible to be like in the US. It's difficult for them to get the credit, and they know the value of the money they're getting. And they are also spending that money judiciously. That's my sense of how people are, acting. But the huge entry of people into the capital market, into formalized financialization, is something that we have not seen ever before in our future. And I think that that's going to be the place where we are going to see a lot more action. And I expect a lot of new entrants into the world of investing, into the world of finance, into formal economy, who are all going to contribute and who are going to be very productive in the future. And things will get better from here. So I think the money is there, and there's more money coming. Thank you, Captain.
Thank you, Shyam. It's a great insight and 3 different insights, and over 620 viewers are watching. I got lots of questions addressed to each one of you. And what I'm going to do, Dr. Narayan, you're there, and Arun is also there. I'm going to address the question what is collected from the various people. I'm going to pass it on to them. I'll now pick up the question which has been addressed to Dr. Narayan first, and it's from Mr. Ram, again from Fiber to Ram. He says, sir, given your experience shaping India's macroeconomic policies, how do you interpret the current paradox, high GDP growth alongside stressed household budgets and widening inequality?
Sorry. Yeah, that's how do you go ahead?
How do you interpret the current paradox, high GDP growth alongside stressed household budgets and widening inequality? Inequality, that's what he's highlighting.
Okay. I think this is a very, very, very important question. Inequality is huge. Inequality is huge because if you really take 140 crore people, I would say if you look at all figures, that the top 1% owns 10% of the wealth in the country. And if you take the top 10%, they own more than 50% of all the wealth in the country. That means hugely it's a skewed growth. And the main reason, if you really look at the reason is that a lack of earning productive skills in several states. I think the good example would be to compare Tamil Nadu and Bihar, where Tamil Nadu high level of education, high level of skill formation is leading to much better outcomes in terms of employment, where in Bihar low levels of education and low levels of skill formation is making them depend entirely on manual labor. So here I don't know whether you call it policy, you call it political ideology, or you call it different DNA of the different states. But definitely, this kind of difference if you see Tamil Nadu, if you see Kerala, if you see Telangana and Andhra Pradesh, it is correctable. It is correctable over a period of fairly short in the history of 15 or 20 years. It is correctable. So it is not that this differential need not grow away, but it's very much in the hands of the local governments and the local people to make this happen. So yes, high inequality exists. High inequality is leading to skewed expenditure levels, definitely, to overvalued real estate levels, etc. Absolutely. Conspicuous consumption, certainly. But it is also, I would say, on the positive side, that if I see the development of a state like Tamil Nadu, Maharashtra, Gujarat, etc., I see that this is correctable over a period of time.
Thank you, Dr. Narayan. In a question which is in sync with the similar one is Mr. Raghuveer is addressed to Mr. Dr. Arun Kumar. His question to you, sir: the rich and poor gap is widening very sharply. How much the current economic growth is actually accruing to the top 1 to 5%, and how does this distort the overall economic indicators? This is addressed to Dr. Arun Kumar.
Thank you very much for this question. As I was saying, we cannot talk about Indians and people. Indians are very disaggregated. That's what I was trying to show, that the organized and the unorganized sector are very different. The incomes of the organized sector have been growing, but the incomes of the unorganized sector have been declining. So that's why the inequality is rising. It's not just interstate, but within each state also, within Tamil Nadu also, within Maharashtra also. And you can see in Maharashtra, for instance, the Vidarbha belt has a lot of suicides because the farmers are committing suicides because their incomes are very low. So this inequality is across states, it is within states, and it is basically because of the split between the organized and the unorganized sector. And rural demand is actually very small in India, because you see, rural demand depends largely on agriculture, and agriculture is only 14% of the GDP. Now you can add a little bit of services. Maybe 20% of the demand comes from rural areas, 80% comes from the urban areas. So therefore, even if rural demand rises by 10%, is very small compared to if the urban areas or the services sector now 55% plus. So if the services sector growth takes place, that will lead to far more demand, right? What will happen in agriculture, because it's become a minor sector, there, even if you have a 4 to 5% rate of growth, the demand will not rise that much. So I think what we need to do is we need to equalize all this. So if we are to do something like this, then we have to boost agriculture incomes. Agriculture incomes are very low in India. The last survey was 2017-18, which showed that an average agriculturist earns, 27 rupees per person per day from agriculture. So they have to do other things. They cannot depend on agriculture alone. So at 27 rupees per person per day, you can see the annual income is only 60,000-70,000 rupees in 2018. That would have gone up to maybe 1 lakh of rupees. But 1 lakh of rupees of income from agriculture for a family is very small. So they are close to the poverty line. So how to boost agricultural income, that's one. Second is the micro sector is very large. The micro sector has 7 crore units, and average employment is 1.7% per micro unit. Now you cannot make them organized. Just like agriculture cannot be turned organized, the micro sector cannot be turned organized. And of the MSME employment, micro sector has 97.5% of the employment. So unless you boost the micro sector, demand in the economy will not rise and inequality will not become less. Unfortunately, what the government is doing is it is killing those areas where employment generation is buoyant. So the government increases their capital expenditure on highways and on railway freight corridor, on power sector, on IT sector. But these are very capital intensive. They don't employ many. Say, for instance, earlier on a road project, hundreds of people were seen to be working. Now 10 people are working with bulldozers and with tractors and so on. So even these sectors don't generate employment. Where is the employment generated? In the rural employment guarantee scheme, in education, in health, in rural development and agriculture development. But these are the areas which are lagging behind. And that's why employment generation is not very buoyant. And if the unorganized sector was buoyant, you'd get a lot of employment. But because the unorganized sector is declining, you don't get that employment. Therefore, the inequality rises. So therefore, what the government has to do is boost agriculture, boost the small and micro sector. Then purchasing power will come in the hands of the presently poor, and they will spend a lot. If you boost the income of upper middle class and the rich, they are not going to consume. Out of every 100 rupees you give them, they may consume 5 rupees. But if you give the 100 rupees to a poor person, a farmer, or to a micro sector worker, he spends the entire 100 rupees. He'll buy a chappal for himself, he'll buy a sari for his wife, he'll buy some school bags, some katori. So to boost demand, you have to shift income. So if the inequality keeps rising like this, demand will be slow, and then the corporate sector's growth will be slower. It will slow down. That's why I said it'll be unstable. So therefore, you have to have policies which are focused on trying to boost the income of the lower 94% in the economy.
Perfect, sir. I think, Shyam, there's a question. I think people are listening to the raising question. Now the question is addressed to you on similar lines. The two questions I'm combining, Aravind and Pushpa. And the first question is this phase of high growth and rising asset value reflective of a strong fundamentals, or are we experiencing another liquidity bubble? In continuum, we also want to know how worried should India be about the growing inequality between the top earners and the rest of the population? What are the long-term consequences of the same? Because seeing the stock market is only a few very negligible percent we are there, and as the speaker said, quite a number of them earn, some lose heavily. What do you think in the present scenario to address the concern of Pushpa and Arvind?
I think definitely the market is under the influence of excess liquidity. There's no doubt about it. And that reflects in the valuations of businesses. The stock market valuation that you currently see is definitely a bit overdone. And it is primarily because of lack of opportunities in other asset classes. And the excess valuation real estate is pushing a lot of people to take money out of real estate and come to stock market. Today, with gold also hitting highs, I think a lot of people who want to invest in gold are thinking, let me invest in stocks right now, because relatively stock market seems to be a better place. Having said that, I think that the larger Indian companies are in better financial health today than ever before in the last 10 years or even 20 years. So the larger financial companies, larger Indian companies, not just financial companies, the larger Indian companies are in much better financial health, and that in turn provides a lot of stability to the stock market. So even though there will be a little bit of froth in the stock market, let's say markets are overvalued slightly, any change in valuation will again make more people show their conviction in Indian assets, in equity. That's my sense. And we will see corrections, for sure you will see corrections, and that is very healthy also in the long run. And these corrections will see more people coming in and participating. It will be a very dynamic market. It will not be one way, as we have seen from the lows of the COVID to the present. But it will be a market which is constantly adjusting to the economic realities. And the economic realities will also see a lot of ups and downs, because that's the nature of the times that we live in. So overall, an investor in equity market should be prepared for all this. I think that is the most important thing. You must be ready for these ups and downs, and you must be able to capitalize on these opportunities. Talking about inequality, I think that today we are seeing the highest tax rates in our post-liberalization history in personal finance. So you are seeing highest taxation in the hands of individuals who are rich. Okay. On the other hand, you are seeing the lowest tax rates in post-liberalization history. Post 1991, I'm saying. You are seeing the lowest corporate tax rates. So what the government is telling is, if you keep the money in the company and invest in the business and create assets, then you're free to enjoy a lower tax rate. But if you pay the money to your owners, business owners, who are essentially rich, then they have to pay out 40 rupees out of 100 rupees that they get. Now, the government has done almost everything it can do to address inequality from the angle of taxation. If there is still this phenomenon of the rich becoming very rich, it's a function of stock market valuation, which is dynamic. I think that if you have a correction in the stock market, then will you say that the inequality has come down? Right? If you see a stock market which is 25-30% cheaper than where it is today, will you say that the top Indian corporates are the business owners, the big names, have all now come to a more realistic level and you'll find it acceptable? I think that this whole debate is based on notional wealth, and they are not going to sell their wealth tomorrow and do anything. Okay, so I think that statistically it looks very, very alarming, but in reality, I think that the more important thing is how many people are coming into the middle class, how many people are able to add different things to their consumption pot or basket. How many people are able to enjoy a better quality of life? How many people are able to buy a two-wheeler? How many people are able to build a house? How many people are able to buy a car? How many people are able to educate their children in universities? How many people are able to get the best medical facilities? So I think that you have to look at that and not look at whether how rich you are relative to the richest guy. I think it doesn't really matter. If I am coming into the middle class and I'm getting everything that I aspire for, it doesn't matter how rich the richest guy in the country is. I think it's more academic to me, and I would think that's how an ordinary Indian would view it.
Great, Shyam. I think it's a good point. And now I have a question for Dr. Narayan. Sir, you're there, Dr. Narayan. Can I address the question to you, sir?
I am here.
Yes, sir. The question to you is from Mr. Mittal from Nagpur. He says, what reforms or the rails should India consider to ensure that growth is inclusive, inflation is contained, and asset price inflation does not result in future correction of crisis? So, based on your experience as advisor at the highest level of Prime Minister, what should be your view as on today?
That's a big one. That's a big one. So certainly start at one end, certainly agriculture, modernizing agriculture, making it more income earning for the agriculturist, taking it down the value chain, right up to marketing, adding value to the product in terms of what shall I say, in terms of conversion from raw material into something which is good to the table. It's happening, but it's happening. You can see when you go to the store, you can see all this is happening, but it's happening so very slowly because there's not enough push being given by government to this particular aspect of it. So that is one big area. The second area, which is already pointed out, is certainly micro and small industry. They need technology, they need R&D, they need marketing, they need they need access, they need logistics. These are the kind of support that the government should give, because they can't do it by themselves. I mean, if you take a district like Nilgiris, a large number of self-help groups doing wonderful things, but they are not able to expand. They are not able to expand because they don't have access to the market, they don't have access to technology, they don't know how to brand their goods, etc. So I think this is one area that government should certainly do. So if I were to look at inclusive growth, certainly I would look at the small scale sector and the agriculture sector as the origin of inclusivity.
Thank you, sir. I think great insight. And here's a question addressed to Dr. Arun Kumar. So many of them coming and trying to put what is relevant to the talk discussed only we are putting it. I know a lot of communication happening in the chat box, and I'm not really looking at it, sir, because we are not here to really address the personalized questions. So I bear with me. You can just see them, and something you think is relevant, we'll try and address them. We got another 10 minutes to go. There are some lovely questions that come from all over India. The next one is come from Mr. Butt. It's addressed to Dr. Arun Kumar. He says, to what extent do you believe the parallel black economy contributes to the sudden surge in asset prices? Are we missing a hidden flow of money unaccounted for in the official data? Because you're an expert in the black economy, you written a book post 1991 war. I think somebody has really researched and picked up this question for you, sir. Over to you, Dr. Arun.
Yeah. So, the black economy generates a lot of income. According to my estimate for 2012-13, it was 60% of GDP. So on a 350 lakh crore GDP, 200 lakh crore would be the black income generation. Now, the problem with the black economy is that investment productivity declines. So therefore, it leads to a lower rate of growth than the potential of the economy. So while the black economy leads to a higher GDP, but the point is that it could be much higher. So I've shown in an article in 2005 in South Asia Journal that because of this black economy being more than 10% of GDP from mid 70s, India is losing on an average 5% rate of growth. Now, if this 5% rate of growth could be added from mid 70s onward, today Indian economy would be $30 trillion rather than $3.8 trillion. So we are missing out something like $26 trillion of GDP because of the existence of black economy. Now, what does the black economy do? A large amount of investment goes into unproductive assets. And like, for instance, buying gold or, taking the money out through hawala, through a layering process and, bringing it back. So round tripping is taking place because of the use of black economy, and that goes into the stock market and various other things. And that leads to a boom in the stock market as a result. So, what is happening is that because income from white assets is not comparable to those from the black assets. Therefore, the shift is towards the black economy. And that black economy leads to, loss of productivity in the economy. To give an example, suppose you make a road. You don't put enough tar in it. The rain comes, the road gets washed away. So the investment is not giving you the productivity you should have given in terms of better traffic. There'll be potholes, people will die, there'll be axle broken, etc. So I call this digging holes and filling holes. So large part of the black economy like digging holes and filling holes, which leads to loss of investment, loss of productivity, etc. So black economy leads to several negative aspects of the economy. So while the economy is larger than what the white economy data suggests, but it also has negative effect because it slows down the growth of the economy. And the slower growth means less of employment. It means other inequality, because this black economy is concentrated in the hands of 3% of the population. So 3%, I showed that in 1996, 97, if you take the white economy, then the ratio of income between the rich and the poor is 1:12. But if you include the black economy, then it becomes 1:57. So the real inequality comes from the black economy. And that then suppresses your productivity, suppresses your demand in the economy, and therefore leads to slowing down. So it makes the economy very unstable. And also it has political effect, it has social effect. Your politics gets affected, so your political class is unaccountable, and therefore it doesn't deliver. And social effects are also there. For instance, education is not properly done because the teacher is more interested in doing a tuition rather than teaching in the class. The doctor doesn't cure you in time so that he can make more money, can give you more tests, and things that are not needed are done. So it has social effects, political effects, and economic effects. So black economy is, in my mind, the single biggest problem of the Indian economy. So while it means additional purchasing power, no doubt, in the hands of the top 3%, but it has deleterious effects on the entire economy and creates much more inequality than the white economy alone would have done.
Thank you, Doctor. As usual, in your own style, I think it's been put forth so beautifully. Now, I think there's an interesting question has come to Shyam. Maybe another 5 minutes more. I'll try and accommodate as many questions as possible. Shyam, this question is from Mr. Satish and Jindal. I combined two questions. He says, given your portfolio management perspective, what hidden risk do you see beneath Indian seemingly unstoppable market rally? And you also want to know, in an environment of such high prices, volatile signals, and aspirational spending. What should middle class investors prioritize to avoid long term financial vulnerability? Because I know quite a bit of middle class guys that lost huge money. And what would be a single word of advice under the present circumstances?
Yeah, I think the middle class would reorient their investment focus in the capital market right now to invest more in larger companies. I think that the middle class is now almost obsessed with buying smaller companies. There, I think the risks are much higher. So I think that the middle class should definitely orient towards buying larger businesses, because the larger Indian businesses are in much better financial health and capable of weathering any adverse economic circumstances, and they are much better placed than the smaller and the mid-sized companies. So I think that the middle class should definitely focus on investing in larger companies right now. If you ask me what is the risk to the investment, market or the future of the market in the near term, I think that the liquidity that the market is receiving right now may be inadequate to the kind of capital raising that issuers of equity want. Like, I think that the amount of money which corporates and investors in various companies want to raise through IPOs, FPOs, through placements, all these things is of a much higher order than the kind of liquidity that the market can provide. When the market runs out of liquidity and the issuers are still very hungry for liquidity, I would think that a correction is likely to happen. And that correction is something which the stock market seems very, very underprepared for. So I think that the market has to prepare for that, because corrections are a part and parcel of the equity market. And you will see corrections in every market cycle. Sometimes the corrections could be very deep and long running. Sometimes the corrections could be not so deep and short lived. I think we have had an era of the second category so far. Last 2-3 years, we've seen short-lived corrections. And I won't be surprised if we have a long-running correction for a few years also, because it's entirely a function of a global equity sentiment. And it's quite likely to happen. When it happens, the investor must be prepared both in his portfolio by positioning it towards more safety. And he must also prepare himself to invest when it happens, because that is what will give him future wealth. Because such an opportunity should never be missed. As a portfolio manager, I would like an investor to do all of these things.
Excellent. Keep adequate safety net around you, and many times we stay invested, you can do. But anyways, next question. I think one last question to each of the speakers. I got a lot of questions. We picked up one each, with your permission, sir. The first question I'll have to Dr. Narayan. The question is, sir, historically, the bullion and the real estate acted as a buffer against the stock market volatility. Today, all the three are rising simultaneously. What structural or policy shift could explain these unusual correct correlations?
No, it's not a policy shift that can explain this correlation. It's a market. It's really the market. The market is valuing, and the price. Okay, there are two separate boxes. The bullion increase is related to international market, international geopolitics, things which are happening around the world, and particularly the prices of oil, prices of alternate commodities, of metals, etc. Silver is also rising extremely fast. So this is a feature of the market. There is not a single country's policy which can adjust the price of gold internationally. So I don't think that that is possible. If you look at real estate prices, certainly real estate prices are rising as a consequence of all that we have been discussing this evening. There is more money, there is more liquidity, there is more investable capacity, there is more debt that is available, and certainly the returns out of the piece of land in agriculture are very, very much lower than converting it into real estate. And if there is a market for a growing real estate market, and therefore if there are buyers, and where do the buyers come from? The buyers come from the aspirational middle class, from the youngsters. So if there are buyers, definitely the seller will find it much more capable of making more money out of selling his piece of land rather than to grow potatoes or tomatoes there. So, I mean, this is, I would call it a virtuous cycle. We only have to make sure that our breadbasket does not get disturbed because of this urban explosion.
Thank you, sir. Thank you so much. Now, the one last question to Professor Arun Kumar is, sir, the questions come from Miss Mini. She says that the GDP numbers are being revised upward repeatedly. Do these figures reflect real on-ground economic well-being, or are they masking structural weaknesses in employment, wages, and consumption? He also wanted to know, in your assessment, where is the money coming from? What component of economy is supplying the surplus capital, and which is it sustainable in the long run? A quick answer to this.
Yeah.
I know it's
Yeah.
difficult, but
So there are several questions rolled into one. Let me say, what's happening is that the organized sector is having large growth, and that is where the money is. And that is what is circulating in the stock market. That's what is circulating in buying gold and so on. And why the preference for gold? Because globally there is huge uncertainty. Whenever there's uncertainty, people go into gold. The central banks are also going into gold because now the de-dollarization is taking place. So China is shifting to gold, our RBI is shifting towards gold, etc. So there's a lot of gold buying in the international market, which is pushing up the price of gold. So in other words, the whole point is that you see, now we are a globalized economy where different parts of the world affect us. So what used to happen before 1991 is different from what is happening now. Before 1991, there was a switch between the stock market and the real estate market. Now there are many more assets. You can hold your money abroad. You can hold it, in different ways. And the gold prices globally used to affect us. But gold is now being affected by the uncertainty that is there. Now, regarding the GDP revision, there are two things. One is that you see the GDP, the method of calculation itself is incorrect. And that's why there is revision going on all the time. And as I said, the unorganized sector is not captured in it, and therefore the unorganized sector not being captured, it is overinflated. That's what I am saying. Third is that the GDP doesn't reflect the well-being of the unorganized sector, because the GDP is reflecting the well-being of the organized sector, which is growing. The unorganized sector, which is contracting, but then we are assuming that the GDP of the unorganized sector is also growing at 6.5%. So the well-being of the unorganized sector is not reflected. Secondly, even the organized sector, there's a lot of disparities. You can have workers working at, a small income. You have contract workers working at low incomes. And then you have the managerial class where the incomes are growing. And then in the software industry and the computer industry, the incomes are growing. So there's a dispersion there also. So the average GDP doesn't reflect this thing. And the structural problem is the organized and the unorganized sector, as Mr. Narayan also said, and I said earlier, agriculture is a problem, the micro and the small sector are a problem. These problems need to be addressed, and those are structural problems.
thank you, Doctor. And one last question to Shyam, and maybe a quick short answer so that we wrap up in time. The question is from Mr. Sudarshan. Sudarshan is from Dindakal. He says, are retail and high net worth investors responding rationally to the economic signals, or are current investment flows driven by behavioral biases or herd mentality or misinterpretation of macro India? Is it the economy going in the right direction? And what's your advice as high net worth advisor to individuals?
Behavioral biases are part and parcel of the equity market. There will be no equity market without behavioral biases. And people with more money have a higher tendency to show higher behavioral biases. It's very normal. As far as the retail investor is concerned, he cannot afford to show behavioral biases, because if there is a loss, then for him, it can really pitch. So I think that the retail investor has to always keep his behavioral biases in check. As far as the HNI or the ultra HNI is concerned, I think that even if he has behavioral biases and there are some ups and downs, he can weather it. It will not really affect his day-to-day life. And, he can wait for some time before he, makes more money. So the needs of the two are very, very different. But I believe that any investor should keep his behavioral biases constantly in check. And they should be driven less by recency and more by the future. So I think if you're able to do that, then you will be able to participate much better in the equity market, get much more value out of equity as an asset class, and stay the course much longer. Because I think that eventually it's all about staying the course. What behavioral biases are doing to people is it doesn't allow them to stay the course for 5-10 years in anything.
Thank you.
You have 90% of investors don't stay beyond 2 years in anything, in any investment. So if you're able to stay the course, then I think that you are going to overcome behavioral biases and you will be able to do much better in the long run.
Thank you, sir. I think we come, and maybe before we close, one final thought. I want to request each one of the speakers to share your 30 seconds insights on where is the money coming from, and all that discussed, so many insights that come. So start with Dr. Narayan. 30 seconds, your thoughts on the subject, which is very, very relevant, and most people will be really interested to know that. Over to Mr. Narayan. 30 seconds, final thoughts.
I think a lot of government investment, capital investment, money is flowing in. A lot of improved corporate performance, financial market performance, a lot of money is coming in. I said a lot of retail debt and consumer spending, a lot of money is coming in. Agriculture production has increased, a lot of money is coming in. And real estate, finally.
Thank you, Dr. Narayan. Arun, what's your thought?
So, we have to distinguish, as I said, between money and income. Money is a part of your portfolio of assets. So money doesn't come in unless you make savings. So incomes lead to savings. And savings are very disaggregated because those, like Hindu had a story day before yesterday, 90% don't save. Only 10% are saving in India. So the savings are coming from the top 10%, and that too from the top 3%. And the top 3% also, a lot of savings are escaping the economy through flight of capital. So therefore, the full savings is not coming in. It may be round trip back into the stock market. That's another matter. Agriculture is very small in India. So not much saving is coming in from agriculture because only 14% of GDP and spread over 11 crore farmers. So not much savings are coming from there. They're very small saving. It's the services sector, which is very large, more than 55% of GDP. It is from there that the savings would be coming into the thing. So this is a very disaggregated analysis that is needed. We cannot say that there's people of India. We cannot say Indians, the people of India are very diverse. Indians are very diverse. So we shouldn't lump them together. We should disaggregate them and then find out who's saving and who's investing.
Thank you. I go to Shyam. Before that, I also want to request like Dr. Mr. Lakshmi Narayan, my president MMA. He's again a corporate leader. Maybe he want to share a thought, 30 seconds on where the money coming from being business. Over to you, Shyam. In the meanwhile, Mr. Lakshmi Narayan may join. Shyam.
I think money is coming primarily from the government. It's coming from the banking system. It's moving across asset classes, and it's moving from assets to consumption. And I think that all this is basically giving people a wealth effect and a confidence to spend. It's important that these trends are always kept in check and never go so much overboard that we have to have drastic corrections. So I think that it's important that the balance is constantly maintained in keeping money in the right place.
Thank you, Shyam. I'll now go to Lax. You have been pumping money in the hands of people to create wealth. And what's your thoughts, Mr. Lakshmi Narayan? You have to unmute yourself. You have to unmute, Mr. Lakshmi Narayan. One final thought.
He's not able to unmute.
Oh, listen, Shankar. iPhone.
Sir, yes, sir. You can try now, sir.
Yeah, you can unmute now.
Yeah. No, absolutely. It's just been a wonderful session listening to all the speakers. My view of where the money is coming from is, what Mr. Narayanan said and what some of the other speakers also said is a lot of money is coming in from, land monetization. And with a lot of agricultural lands getting converted into commercial and residential real estate parcels, now overnight, one of the speakers said like it's gone 2x in 5 years. It's gone 5x in 5 years in some of the markets, and suddenly who were agriculturists holding land over the last few years, few decades, and now sitting on crores of money. And land monetization finds its way back into either land or in gold or in similar such activities which are cash economies. So that's where I guess money is coming from.
Thank you, Lex and Satyamurthy sir. One final thought. You are the creator of this. You would like to say something? And before that,
Not really.
I'd like to honor
Everyone has said the best of things.
Thank you, Shankar.
Carry on.
Thank you so much, gentlemen. You have joined us and sharing your great insights. You are separated, but you're not there. The MMA would have given a nice memento. Since you are there, we would like to present you a digital memento. What we do is, on behalf of you, we go to the school where the poor children are studying. We present them with the book, textbook, all of them on your before, because people like you come and speak at MMA. That is what adds tremendous value to MMA. And this is what we share with a lot of poor children, so that with your blessing, they all do. We study, do it with a lot of schools which are really government-aided schools. Thank you so much. Your presence add tremendous value to this evening discussion and quite insightful. I think over 700 viewers are watching the program from different social media portals. It's indeed a privilege to hear you in online, and thank you once again. And it's lovely having you with you. Till we meet again, sir. Bye-bye and good night.
Thank you for organizing.
Thank you.
For the gift to the students. Thank you very much.
Thank you very much.
All the best. Bye. Bye.
Thank you,
Mr.
everybody. Good
Narayan.
night.
Thank you, Mr. Satyamurthy. Thank you, Dr. Narayan. When you come to
Thank
Chennai,
you.
we'll catch up with you. We'll come and meet you. When Satyamurthy is there, we'll come and talk to you sometime. And the entire talk will be recorded. This has been transcribed and will be published in our digital magazine this month. Thank you. Thank you so much. And thanks to all the viewers who joined us. So many questions have just come in the chat box, but no, there's so many other questions that come. We have to prioritize based on what actually the discussion on the theme. That's why reason the committee which picked up the question sent to me is not picked up your question. Thanks anyway for joining us online and sharing your question. Thanks so much to everyone.
Thank
Good
you.
night. Till we meet again.
Bye.
Bye-bye and good night. Satyamurthy sir, 7:35 sharp. We closed it so
Yes.
that we can go and have the dinner properly. Thank you, sir.
Right, sir.